Okay, thank you everyone, and welcome to our education session on IPSAS 46. That is the measurement standard in the IPSAS suite of standards. Just to note our general disclaimer that the views and opinions expressed today are my own, and that official positions of the ASB on accounting matters are determined only after extensive due process and deliberation. Okay, so just to explain the ASB measurement project a bit. We have started our project to develop a standard of GRAP on measurement. We are in our very early stages. So as part of our research phase, what we want to do is firstly identify measurement issues in the standards of GRAP. So we've conducted those meetings already. So I just want to say thank you to all stakeholders for your comment on the issues that you experience in measuring assets and liabilities while applying the standards of GRAP. What we are doing in today's session is that we will discuss the principles in IPSAS 46, that is the measurement standard in IPSAS. The whole point of having an education session is for stakeholders to go and ponder about the principles in IPSAS 46, because what we want to do after this is then assess whether IPSAS 46 is appropriate for our local environment. This will then help us at the ASB to determine how closely we align with IPSAS 46 when we develop our standard of GRAP on measurement. And in areas that we do depart, it does make sense and it will be then better for the South African public sector. I have had this question before, so I just do want to make it clear in case anyone is wondering that we are not saying in this presentation that members should apply IPSAS 46. Please do not do that. Please do not apply IPSAS 46. If members would like to know which standards of GRAP are applicable for the year that they are reporting on, then members should please have a look at Directive 5, which is available on the ASB website. Okay. Moving on then to the overview of today's discussion. We would look at, firstly, the IPSAS-B conceptual framework for general purpose financial reporting by public sector entities. Here we are going to look at the specific chapter that deals with measurement of assets and liabilities. We will then look at the principles in IPSAS 46 measurement. Okay, starting off with the IPSAS-B conceptual framework. Now, Chapter 7 of the conceptual framework identifies measurement concepts to guide the selection of measurement bases for assets and liabilities. They guide the IPSAS-B in the selection of measurement bases for IPSAS and also prepare us in selecting measurement bases in the absence of requirements in any individual IPSAS. It also provides guidance on the selection of measurement bases for assets and liabilities in order to meet the measurement objective. Now, what is the measurement objective? The measurement objective is to select those measurement bases that most fairly reflect the cost of services, operational capacity, and financial capacity of the entity in a manner that is useful in holding the entity to account and for decision-making purposes. Now, when we look later at IPSAS 46, that's the measurement standard, you will see that the measurement objective there is closely aligned to this. Moving on to initial measurement. Now, what does the IPSAS-B's conceptual framework say about initial measurement? For an asset, initial measurement is at the transaction price plus transaction costs. For liability, initial measurement is at the transaction price minus transaction costs. Now, where there is no transaction price, or the transaction price does not faithfully present relevant information, then deemed cost is used. Also, just to note, this does not mean that this is the requirement in each of the individual standards. For example, in financial instruments, the treatment of transaction costs depends on the classification of the instrument. Moving on to subsequent measurement. Now you will see this diagram appear a lot in today's presentation. It gives a nice overall view of how to apply the measurement requirements in IPSAS. Now looking first at measurement models. These are the approaches for measuring assets and liabilities in financial statements. There are two models identified in IPSAS. It's the historical cost model and the current value model. Looking next at measurement bases. The measurement bases are the specific ways of measuring assets and liabilities under the measurement model selected. So you will see in this diagram that under the historical cost model, there is just one measurement base, that is historical cost. Under the current value model, there are three bases, which are current operational value, which are for assets, fair value for assets and liabilities, and then cost of fulfillment for liabilities only. Lastly, in green, on this diagram, you'll find the measurement techniques. These are the methods to estimate the amount at which an asset or liability is presented under the selected measurement basis. Now we'll unpack each of these in a bit more detail when we move on to IPSAS 46. So looking here at the split of measurement bases for which are applicable to assets and then which bases are applicable for liabilities. For assets, the applicable bases are historical cost, fair value, and current operational value. And then for liabilities, the bases applicable are historical cost, fair value, and cost of fulfillment. Now, value in use is mentioned in the conceptual framework, but it is no longer a measurement basis. It's not included in the list of measurement bases because its use is limited to impairment. Okay, so let's have a look at the measurement basis and the summary of changes in the IPSAS conceptual framework. Starting off first with historical cost. This is an existing measurement basis for assets and liabilities. So when we say that, it was in the old IPSAS conceptual framework, and it is still now in the new IPSAS conceptual framework. Here, what is different in the amendments and in the new conceptual framework is the inclusion of transaction costs in the definition. It is also the only basis under the historical cost model. Looking next at fair value. This is a new measurement basis in the conceptual framework to replace market value for assets and liabilities. It is drawn from IFRS 13 on fair value measurement. It is a current value measurement used when assets and liabilities are held for financial capacity. Next, we have current operational value. This is a brand new measurement basis in the conceptual framework. It is a current value measurement used when assets are held for their operational capacity. And lastly, cost of fulfillment. It's an existing measurement basis for liabilities. So it was in the old conceptual framework and it is still in the new conceptual framework. And here there are no substantial changes. Now we will have a detailed discussion on these four measurement bases in the next part of the presentation on IPSAS 46. IPSAS 46 describes these measurement bases in detail and also identifies the techniques used in applying the bases. Right, moving on then to IPSAS 46 on measurement. So this standard is effective from 1 January 2025 for those entities that apply IPSAS, and entities are then required to apply the standard prospectively. Okay, so what we will do in today's presentation, in our overview of IPSAS 46, we'll have a look at the objective, the scope, we'll discuss initial and subsequent measurement, and then we'll just end off with potential benefits and implications. So what is the objective of IPSAS 46? IPSAS 46 defines measurement bases that assist in reflecting the cost of services, operational capacity, and financial capacity of assets and liabilities. This objective is aligned with the measurement objective in the conceptual framework, which explains that the measurement of assets and liabilities should be used to reflect, firstly, the cost of services, that is the cost of services provided in the period, either in historical or current terms, operational capacity, that is the capacity of an entity to support the provision of services through physical and other resources, and financial capacity, that is the capacity of an entity to fund its activities. IPSAS 46 also identifies approaches under those bases to be applied through individual IPSAS. Now, when should entities apply IPSAS? IPSAS 46 is applied when another IPSAS requires or permits the use of one or more of the measurement bases. It's applied to both initial and subsequent measurement. Now, what's not in scope of IPSAS 46 is leases. The measurement is done in terms of IPSAS 43, service concession arrangements, naturalizable value, because that is dealt with in IPSAS 12 on inventories, and also value in use, which is covered in the IPSAS standards on impairment. Moving on to initial measurement. Items are measured initially at transaction price plus or minus transaction costs, unless the transaction price does not faithfully represent the asset or liability, or it's required or permitted by another IPSAS. Now, transaction price is the consideration given to acquire an asset or received to assume a liability. IPSAS 46 sets the principles on initial measurement, and then other IPSAS will guide on what the transaction price is at initial measurement. For example, an IPSAS refers to costs unless it is a non-exchange transaction. Then if it's a non-exchange transaction, entities then use deemed cost. Now, when an asset is acquired or liability is assumed in an orderly market, the transaction price reflects the initial value of the asset or liability negotiated between market participants at the measurement date under current market conditions. Where a transaction price exists, it is presumed to present relevant information on the date the transaction occurred. So when determining whether the transaction price presents relevant information about the asset or liability, an entity then considers factors specific to that transaction and to the asset or the liability. Let's discuss now transaction costs in a bit more detail. So transaction costs incurred to acquire an asset or to incur a liability. These are included at initial measurement of the asset or liability to enter into the transaction, but they are excluded in subsequent measurement. For transaction costs incurred to sell an asset or to settle or transfer a liability, these are excluded in initial measurement of the asset or liability, but are included at subsequent measurement because they are incurred to exit the transaction. Transaction costs are only those incremental costs that are directly attributable to the acquisition, incurrence, or disposal of an asset or liability, and they would have not been incurred if the entity had not acquired, incurred, or disposed of the asset or liability. Now, identifying whether measurement bases provide entry or exit values, these usually support the determination of the approach to transaction costs. So entry-based measurement bases will normally include transaction costs on the acquisition, construction, or development of an asset or the incurrence of a liability. While exit-based measurement bases normally include transaction costs on the sale of an asset or the fulfillment or transfer of a liability. Now we'll discuss entry and exit values a little bit later. Okay, so now let's discuss deemed costs with respect to initial measurement. Deemed cost may be used to estimate the initial measurement of assets or liabilities when the transaction is not undertaken in an orderly market. So this is when the transaction price is unobservable or does not faithfully present relevant information on the asset or liability, or the transaction price is zero. So IPSAS 46 does identify some instances where deemed costs may be applicable. I think for our understanding, this will largely relate to what we know as non-exchange transactions. Let's just go through some of the examples of when transaction price does not faithfully represent the asset or liability or is not observable for IPSAS 46. So these instances are when the transaction price includes a concessionary element, an asset is transferred to the entity free of charge by a government or it is donated, a liability might be imposed by legislation or regulation, a liability to pay compensation or a penalty arises from an act of wrongdoing or a breach of contract. The transaction price is affected by relationships between the parties or by financial distress or duress by one of the parties. And the transaction price information is not available on the date of adoption of IPSAS. Right, so those are the instances that IPSAS 46 identifies. Now, deemed cost is estimated using one of the current value measurement bases. The difference between deemed cost and the consideration received is recognized as a revenue expense. Okay, moving on to subsequent measurement. An accounting policy choice is made to ensure an asset or liability at the historical cost model or at the current value model. So this also depends on what the individual IPSAS requires. This means that entities will need to make decisions about which measurement model, measurement bases, and measurement techniques to apply. Looking at selecting the model, historical cost model versus current value model. Now remember that the measurement models are your approaches to measure assets or liabilities in the financial statements. Assets and liabilities recognized in financial statements are quantified in historical terms or current terms. Now, the choice between the historical cost and the current value measurement model considers the following. It considers the characteristics of the asset or liability being measured. It considers the measurement objective, which we spoke about earlier. And it also considers the monetary information being presented. Let's look now at selecting the measurement bases. The measurement bases are the methods to present relevant and faithfully representative information under the measurement model selected. Now, selecting the measurement basis depends on the measurement model that was applied. So if entities chose the current value model, then the basis depends on the primary measurement objective of holding the asset or liability. If it's for operational capacity, then the entity holds the asset or liability for service delivery. If it's for financial capacity, then the entity holds the asset or liability to generate future economic benefits. So in selecting the measurement basis, entities should consider the characteristics of the asset or liability at measurement date. For example, if we look at assets, entities need to consider the condition, use, and location of the asset, and also the restrictions on the sale or use of the asset. For example, for fair value measurement, the characteristics are considered if market participants would take those characteristics into account when pricing the asset or liability. Okay, let's look at the definitions of the measurement basis. The conceptual framework and IPSAS 46 define the measurement basis as follows. Looking first at historical cost. This is the consideration given to acquire, construct, or develop an asset plus transaction costs, or the consideration received to assume an obligation minus transaction costs at the time the asset is acquired, constructed, or developed, or the liability is incurred. Fair value. This is the price that would be received to sell an asset or paid to transfer liability in an orderly transaction between market participants at the measurement date. Now, this is different to what we know as fair value in our standards of GRAP, which is something along the lines of an asset is exchanged or liability settled between knowledgeable willing parties in an arm's length transaction. This definition of fair value in IPSAS 46 is aligned to the IFRS definition in the fair value measurement standard. Current operational value. This is a new measurement base. It is the amount the entity would pay for the remaining service potential of an asset at the measurement date. And lastly, cost of fulfillment. This is the cost that the entity will incur in fulfilling the obligations represented by the liability, assuming that the entity does so in the least costly manner. Okay, so the next few slides focus on the attributes or characteristics of the four measurement bases. So is it an entry or exit value? Is it an entity-specific or market-based value? What assumptions should entities make? And what monetary information does the basis provide? For assets, if we look at entry values, they reflect the cost of acquisition, construction, or development. For liabilities, entry values relate to the transaction or event under which an obligation is incurred. Now, looking at exit values, for assets, these reflect the amount derived from the use of the asset and the economic benefits from its sale. For liabilities, exit values reflect the amount required to fulfill or transfer an obligation. Okay, so starting first with historical cost, what are its attributes? It is an entry value because it measures the consideration given to acquire an asset or to assume an obligation at the time the asset is acquired or the liability is incurred. It is an entity-specific value. Looking at the measurement considerations or assumptions, it is unaffected by changes in current market conditions unless those changes trigger an impairment. So with items measured on a historical cost basis, the amount that the item is recognized as initial measurement stays the same throughout the asset or liability's life. It changes then with your depreciation, for example, for an asset or impairment. What monetary information is provided with this measurement base? Here, the monetary information is derived using the price of a transaction or event that gave rise to the assets, liabilities, and related revenue and expenses. Looking next at fair value. A fair value measurement assumes that the asset or liability is exchanged in an orderly transaction between market participants to sell the asset or transfer the liability at the measurement date under current market conditions. It is an exit value because it measures how much an entity would receive to sell an asset. It is market-based because it measures an asset or liability from the perspective of the market participant. Now, an entity measures the fair value of an asset or liability using the assumptions that market participants would use when pricing the asset or liability, assuming that market participants act in their best economic interests. Now, in developing these assumptions, an entity doesn't need to identify specific market participants, but rather the entity identifies the characteristics that distinguish market participants generally. Looking at the measurement considerations or assumptions, it considers an orderly transaction between market participants under current market conditions. Fair value measurement considers that transactions take place in the principal or the most advantageous market for the asset or liabilities. The same assumptions that market participants would use when pricing the asset or liability. So here we spoke about market participants acting in their best economic interest. And also it considers the highest and best use of the asset when measuring non-financial assets. Fair value measurement of a non-financial asset takes into account a market participant's ability to generate economic benefits by using the asset in its highest and best use, or by selling the asset to another market participant who would use the asset in its highest and best use. What is the monetary information provided? For fair value measurement, monetary information is derived using information updated to reflect the conditions at the measurement date. It reflects the changes in the values of assets and liabilities since the previous measurement date. Now, fair value can be determined directly by observing prices in an active market. In some cases, it can also be determined indirectly. Looking next at current operational value. It is an entry value because it measures how much an entity would pay to replace an asset. It is entity specific because it uses assumptions from the entity's perspective, assuming that the entity acts in accordance with its policy objectives. On the measurement considerations or assumptions, it reflects the economic position of the entity rather than the position of the market. So here we can already see the difference with using fair value because that reflects the position of the market. Current operational value, or COV, reflects the current age, functionality, and condition of the asset. So when we speak about current age, functionality, and condition of the asset, we are saying that COV is the amount an entity would pay for the remaining service potential of the asset. The remaining service potential takes into account the current age, the functionality, and the condition of the asset. The following factors are considered. So there are three types of obsolescence that are considered. They are physical obsolescence, that is physical deterioration resulting from the age and use of the asset. Functional obsolescence is also considered. That's the loss of service potential resulting from inefficiencies in the asset. This could also be as a result of decline in its technological use because of advances in the industry now. And then lastly, economic obsolescence. This is the loss of utility caused by economic or other factors outside of the control of the entity. COV also reflects the value of an asset in its existing use rather than its highest and best use. So highest and best use we spoke about when we spoke about fair value. The COV, the value of the asset, is in its existing use. Now, COV assumes that the entity will use an identical or similar asset. An identical or similar asset delivers services or goods in the same manner as the asset being measured. If we can look at an example, if you have an entity that is a power utility and they operate a solar farm, now that is the nature of their existing facilities. If they are going to look for current operational value, then they need to look at the value for another solar farm. They can't, for instance, look at COV for a wind farm. Existing use of the asset is the way in which the asset is used, and it also generally reflects the policy objectives of an entity. So here, if we have to look at an example of the Department of Health, so where they have buildings that are used for hospitals, these are used to deliver services instead of commercial purposes. So they, for instance, would now not, if they have capacity in the hospital building, use it for commercial purposes, for example, letting it out. Because their objective is to deliver services instead of commercial purposes. So they do not look at highest and best use. Now, measuring the existing use of the asset disregards potential alternative uses and any other characteristics that could maximize its market value. Lastly, then, on the measurement considerations and assumptions, COV reflects the value of the asset in its existing location. What is the monetary information provided? The monetary information is derived using information updated to reflect the conditions at the measurement date. It reflects the changes in the value of the assets since the previous measurement date. Current operational value can be determined directly by observing prices in an active market. In some cases, it is determined indirectly. For example, if prices are available for a similar asset, the current operational value of the entity's asset might need to be estimated by adjusting the current price of the similar asset to reflect the unique aspects of the entity's assets in its existing use and in its existing condition. Okay. Let's look next at cost of fulfillment. This is an exit value because it measures how much an entity would incur to fulfill its obligation. It is entity specific. It reflects the cost that entity will incur to satisfy the obligation it has. It also reflects entity specific assumptions rather than the assumptions used by market participants. It also reflects settlement that will be in the least costly manner. This is the minimum amount an entity would incur. So now with this specific measurement consideration and assumption, which is least costly manner, entities don't need to do an exhaustive search of all fulfillment methods to identify the least costly manner, but it should take into account all information that is reasonably available. Now, in absence of evidence to the contrary, the entity's currently selected method of fulfillment is presumed to be the least costly manner. For example, if an entity selects to fulfill its decommissioning liability using its own employees, then it is presumed that that is the least costly manner of fulfillment, regardless of the entity's ability to contract the decommissioning to third parties. Looking lastly at the monetary information provided by cost of fulfillment, monetary information is derived using information updated to reflect conditions at the measurement date. It reflects changes in the values of the liabilities since the previous measurement date. Okay, now moving on to selecting the techniques. The measurement techniques are the methods to estimate the amount at which the asset or liability is presented under the selected measurement basis. So here there are three techniques. It's the market approach, the cost approach, and the income approach. Measurement techniques are applied to estimate the amount at which an asset or liability is recognized under the selected measurement basis. Now, this selection considers an entity's circumstances, the availability of data or information to estimate the measurement basis, and the attributes applicable to that measurement basis. Now, in some cases, a single measurement technique will be appropriate. For example, when valuing an asset or liability using quoted prices in an active market for identical assets or liabilities. In other cases, multiple measurement techniques will be appropriate. For example, this might be the case when valuing a cash generating unit. If multiple measurement techniques are used to measure the asset or liability under the selected measurement basis, the results shall be evaluated considering the reasonableness of the range of values indicated by those results. Now, measurement techniques must be applied consistently. Where there is a change in a measurement technique, then this is accounted for as a change in estimate in accordance with IPSAS 3. IPSAS 46 requires that entities use measurement techniques that are appropriate in the circumstances and for which sufficient data is available. So let's unpack each of these measurement techniques. The first one is the market approach. This uses prices and other relevant information generated by market transactions involving identical or comparable assets or liabilities. The measurement bases that can use the market approach are fair value and current operational value. Looking next at cost approach. This reflects the amount that would be required currently to replace the service provided by an asset. It's also known as current replacement cost, and this is done through the acquisition or construction of a substitute asset of comparable utility, then adjusted for obsolescence. The cost approach can be used for the measurement bases, fair value, and current operational value. Lastly, the income approach. This converts future amounts into a single or discounted current amount. This measurement or the measurement basis that uses income approach are fair value and cost of fulfillment. Okay, let's now apply the measurement techniques to the different measurement bases. Looking first at fair value. The objective of fair value measurement is to estimate the price at which an orderly transaction to sell the asset or to transfer the liability would take place between market participants at the measurement date under current market conditions. Fair value can be determined directly by observing prices in an active market. In other cases, it is determined indirectly using measurement techniques. IPSAS 46 requires that entities maximize the use of relevant observable inputs and minimizes the use of unobservable inputs. Now, what are observable inputs and unobservable inputs? Observable inputs are inputs that are developed using market data, such as publicly available information about actual events or transactions, and that reflect the assumptions that the market participants would use when pricing the asset or liability. Unobservable inputs are inputs for which market data are not available and that are developed using the best information available about the assumptions that market participants would use when pricing the asset or liability. Looking at market approach and how to apply that when using the fair value measurement base. Market approach requires the existence of market transactions involving identical or similar assets. It also uses market multiples derived from a set of comparables or matrix pricing. How is the cost approach used for fair value measurement? The cost approach reflects the amount that would be required currently to replace the service capacity of an asset. It is the current replacement cost. From the perspective of a market participant seller, the price that would be received for the asset is based on the cost to a market participant buyer to acquire or construct a substitute asset of comparable utility, then adjusted for obsolescence. Now, in many cases, the current replacement cost method is used to measure the fair value of tangible assets that are used in combination with other assets or with other assets or liabilities. Lastly, the income approach. This value reflects current market expectations about those future amounts. It uses several methods, including, for example, present value techniques, option pricing models, and also the multi-period excess earning methods, which is used to measure the fair value of some intangible assets. Okay, now inputs are used when applying the measurement techniques. Inputs are the assumptions used when pricing the asset or liability, including assumptions about risk, such as the risk inherent in a particular measurement technique used to estimate measurement in accordance with the measurement basis, such as a pricing model, and also the risk inherent in inputs to the measurement technique. Now, inputs may be observable or unobservable. We have discussed observable and unobservable inputs. So let's see how all of this fits into the fair value hierarchy. What I was saying here is that this entities may be familiar with this already if they are familiar with IFRS 13 on fair value measurement. Now, for disclosure and comparability purposes, the fair value hierarchy categorizes the inputs to measurement techniques into 3 levels: level 1 inputs, level 2 inputs, and level 3 inputs. Now, what are level 1 inputs? These are quoted prices. They are unadjusted in active markets for identical assets or liabilities, and they are used without adjustment to measure the fair value whenever it's available. These are now your observable inputs. Looking at level 2 and 3, which is when we move from observable to unobservable inputs. Level 2 are the inputs other than quoted prices included within level 1 that are observable either directly or indirectly. Level 3 inputs. These are unobservable inputs, and they are used when relevant observable inputs are not available. They can often be the entity's own data adjusted to account for assumptions of other market participants, and they exclude entity-specific factors, including risk. Okay, let's look at current operational value, so that specific measurement base, and how the measurement techniques apply to it. The objective of current operational value is to estimate the amount an entity would pay for the remaining service potential of an asset based on conditions at the measurement date. In some cases, current operational value cannot be determined directly by observing prices in an active market, and they must be determined indirectly by other means. Looking at the market approach and its applicability to current operational value. So this requires the existence of an active market involving identical or similar assets. The asset price from an orderly transaction should be from the principal market. The value is established by reference to the buying price of a similar asset with a similar remaining useful life or service potential. For the market approach, identical or similar assets include the same characteristics as the asset being measured. Looking at the cost approach and its applicability to COV, this is now used when no active market for similar or identical assets exists. Therefore, it makes then the market approach inappropriate. This is the case for a lot of the time for specialized assets. The cost approach includes the costs to develop or produce a similar asset, and it's also used where no cost information is available or an asset would not be replaced with an identical asset. So here, entities then may use the cost of a modern equivalent asset adjusted for obsolescence and optimization. Okay, looking next at cost of fulfillment. The objective is to estimate the costs the entity will incur in fulfilling the obligations represented by the liability at the measurement date under current market conditions. The cost of fulfillment cannot be observed directly in an active market. It's determined using the income approach technique. Now, the income approach technique reflects entity-specific assumptions rather than assumptions used by market participants. It takes into account the attributes of the measurement basis. This includes the estimates of future cash flows, possible variations in the estimated amount or timing of future cash flows. It also includes the time value of money and other factors that impact the value of the liability. Now, the market approach and the cost approach cannot be used to determine the cost of fulfillment. It is only the income approach that is available to use as a technique for the cost of fulfillment measurement base. Okay, now this brings us to the end of the education session.